Hey, good morning, everybody. Hope your weekend's off to a good start. Welcome to another edition of Coffee with Kirk. Got a couple of different topics today that we're going to talk about. The first one is just the IRS has come out with some final rulings, regulations on how to handle inherited IRAs. So if you happen to inherit an IRA from parents, grandparents, friends, anybody, they've come out with the specific rules on how that has to be done. And then we're just going to talk a little bit about, kind of the markets, the economy, things like that. The big thing is, if you've been following any of these presentations, I've been talking about how I could never figure this year, are we in a deflationary environment, or are we still kind of inflationary? And as soon as I thought one way looked definitive, it would flip and it looked like the other way. But I think I've got a good clue of where we're going now, and I'm going to talk a little bit about that today. So, like I always do, let's jump into some slides here. Get the pretty pictures going. So, if you didn't know, the rules had changed on inherited IRAs, I think in 2019. And essentially, so it's been, 5 years since we've gotten finalized IRS rules on what they're looking for. Took them a little while to do this. But before it was essentially, if you inherited an IRA and you weren't a spouse, then you had 10 years to empty out the IRA. All of it had to be distributed. It didn't matter if it was traditional IRA or a Roth IRA. You had 10 years to zero it out. Whereas before 2019, what the rule was is you had your life expectancy to take the money out. So if you inherited an IRA and you're only 30, you essentially had 60 years to take the money out of the IRA that you inherited. So you had what they call a stretch. So when you inherited this money, you stretched it out for your lifetime, it kind of minimized your taxes. Well, the government needs tax dollars. And so they changed the rule to this 10 year. So they're going to force people to take the money out a lot faster if you're not a spouse. So the new ruling that the IRS has come out with, it basically deals with is there a required minimum distribution if you inherit an IRA? So for the past, 4 or 5 years, we've been operating under, hey, you can do it however you want, long as that money is out of there within 10 years. So if you want to take it all out the first year, great. All out the last year, great. Evenly for 10 years, or however you want to do it. So that's still a potential way to do it, but it depends now. So it depends. What they're looking at is if you inherit the IRA and the person that you inherited the IRA from had already begun their required minimum distributions. So if they've already had to start it, which basically now means they're probably 70, they were 73 or older. So if you inherit from your parents or grandparents and they were already taking a required minimum distribution, then even during your 10-year period, you're going to have to take a required minimum distribution. So you're going to have to at least do an RMD for 10 years, and then you still have to empty it out. So this just means you can't now delay to the 10th year and pull everything out. So this really is going to end up hurting you if you inherit a Roth IRA, because a Roth, you'd want to stretch it as long as you can, take a big distribution in year 10 because you're not going to pay tax on it. So you want that 10 years of basically tax-free growth. So this is a pretty complicated looking chart here, but we'll start all the way to the far right with non-designated beneficiary. So if somebody owns an IRA and they die without designating a beneficiary, that's a non-designated beneficiary IRA. So that would go to your estate or the person's estate. But there's also other non-designated beneficiaries, such as charities or something we call non-see-through trust. A non-see-through trust just means that the trust doesn't identify. It's not specifically for each beneficiary. So it could be a trust that says, for my children. Like if you're still having kids, maybe you're a rich billionaire who's 85 and you marry a 30-year-old and you're still having kids, you just put a clause in there for my children. So it could be one child, it could be 10. So in those cases, that would be non-designated beneficiary for the IRA. So with those rules, they have different rules. If the decedent, meaning the person who had the IRA and left it to the beneficiaries, died prior to their required beginning date or RMDs, they have to be out of there in 5 years. So if it just goes to the estate, if for whatever reason, and this happens more than you'd think, people forget to put a beneficiary on their IRA, and then it goes to the estate. So they might have children, but they just forgot to name them as a beneficiary. So at that point, instead of getting a 10-year rule, you only get 5 years to pull that money out. Charities also get 5 years, but charities usually empty that thing out right away and start investing on their own. And then the non-see-through trust. So if you leave it to a trust that doesn't designate that individual, then it's got to be 5 years. Now, if they've died after their required minimum distribution, they can stretch that out over the decedent's life. Okay, so that a little bit different there. So that's actually a little bit better than the 5-year rule, probably. Those really probably don't pertain to you too much unless you own an IRA and you haven't designated a beneficiary. You need to do that. Or if you somehow end up in like a non-see-through trust that your family set up. But most lawyers don't let you do non-see-through trust. They get you straight, so you probably won't see that too much. So the biggest ones are eligible designated beneficiary, non-eligible designated beneficiary. So the first one on the far left, mostly that's surviving spouse. You'll see that. There could be other things there. They say, right, disabled persons, minor children, some see-through trust, benefiting persons, benefiting the spouse or minor children. So there are some of these, but the big one you'll see there is the surviving spouse. So if you leave it to your spouse, basically the spouse can turn it into his or her IRA, and then the rules apply where they can stretch it out over their lifetime. So the rules now for all of them: surviving spouse, disabled, minor children, if the decedent died prior to the person taking the RMD, they can basically stretch it out over the 10-year period. Now, the stretch for a surviving spouse just means they turn it into their IRA. They can take it from their husband or wife's name into their name, and then boom, the rules are based on when their RMDs begin, and they stretch it out over their lifetime. Otherwise, it would be a 10-year. So, but if it's like minor children, this would be good. Like, I'm not anywhere near at least yet taking the required minimum distribution. So if I left an IRA to my children, they could stretch that out over their lifetime. Now, if the decedent had already hit their required beginning date, which is the RMD date, that one still, you can stretch that out over longer of the beneficiary's lifetime or the decedent's lifetime. So in that case, you here again, you get the stretch. So the first column there, the surviving spouses, disabled folks, minor children, they still get pretty good rules where they can stretch it out over their lifetime, or if they happen to be older than the person who left them the IRA, they could stretch out over the decedent's lifetime. And that could be important. Say, let's go back to that example. The 80-year-old who married a 30-year-old, and she happens to die, so he inherits her IRA. He could actually stretch that out over her life expectancy and not his. So that means he could stretch that thing out a lot longer for tax purposes. So the real reason I'm talking about this, and probably the one that's where the IRS really clarified the rule, is the non-eligible designated beneficiary. So this is going to be most of your non-spouse beneficiaries, and then some see-through trust that designate, if you're a designated person on your parents' trust, it's going to affect you there too. So this is where they really clarified it. So the big thing is, if the decedent dies prior to taking their required minimum distributions, then the 10-year rule is in effect. And that's what we thought it was before, where you got 10 years, do it however you want, but it's got to be zeroed out in 10 years. Okay, so if your parents had not started their required minimum distribution, you've got 10 years, you could structure it however you want, you're good to go. Now, if the decedent had already begun their RMDs, well, at that point, the 10-year rule is still in effect, meaning that by the end of 10 years, it's got to be emptied out. But you're going to have to take a required minimum distribution each of those 10 years. And that's going to be, the stretch is based on either your life expectancy or the decedent's life expectancy. So obviously, if you inherited from your parents, you're much better off doing it under your life expectancy. So you would figure out, what would my RMD be for my age? And you take the money out that way. And then at year 10, you empty it out. But again, go back to that, if somehow a grandchild died and left it to their grandparents, the grandparents might still use the 10 years to stretch it over the grandchild's lifetime and then empty it out at year 10. So the IRS has basically waived any kind of penalties or interest for anybody for years 2024 before. They're obviously, since they've just come out with the final instructions that they've drafted here, they're not going to penalize you, because if you inherited an IRA 3 years ago and you didn't take an RMD, well, why would you? They had not provided any guidance. And they're also exempting it for this year as well. So even if you've had an inherited IRA and by these rules should be taking a required minimum distribution, the IRS is not going to force you to do it this year, because this is the year that they came up with the rules. So you're good on that. Now, starting in 2025, you're going to have to start taking RMDs if by these rules you should be. But you still have the 10-year rule no matter what. So if 10 years from when you inherited that IRA, it has got to be emptied out. Now, if you inherited the IRA before 2019, remember, these rules do not apply to you in any way. So you get to stretch it out over your life expectancy. So if you inherited an IRA in 2018 from your parents, you can stretch that out for your entire life. You do not have to do the 10-year rule. So make sure you're really following the rules on this. Uncle Sammy needs his money, so he's going to be looking at this stuff pretty closely. Okay, let me jump in here real quick. Okay. So got a few questions after last week. Last week was a horrible week in the market. This week, it pretty much almost recouped, at least in the U.S., everything that it lost the week before. Very volatile. That actually is not all that great when you see that kind of volatility. But the one question I started to get from people was the yen carry trade. So I had talked about this as sort of something to watch. And I guess apparently either I didn't do a very good job explaining it, or it really didn't seem like a big issue when I was talking about it. But then last week, it came to the forefront of everybody's mind on Wall Street, everywhere. I've been talking about it way before folks on Wall Street talked about it. Just because it's a pretty big thing. And they claim that's the reason that things were so rocky last week. And I think it was that, plus there's some bad information that came out, on the economy, especially employment. So I think all those things together started to freak out the market, like, hey, we might be heading for kind of a recession or a deflationary environment. And this week, there were some numbers that were good. The CPI number came in much better. So inflation was at 2.9% on an annualized basis. So that had the market happy, thinking, oh, we're going to get rate cuts. So they got giddy. We're going to get lower rates, more liquidity. And then the continuing claims on unemployment were lower than expected. Not that much lower than expected, but they were lower. So like, oh, okay, well, maybe unemployment's not a problem. But they did ignore some of the other factors that weren't good. So we had ISM manufacturing, we had durable goods. Both of those were really bad. We had the Philly Fed, which was also a very bad report, but I guess the market didn't want to look at that. But we'll talk about this. First, we'll talk about the yen-carry trade. So the reason I've been talking about the yen-carry trade is because I think Japan is at a point where things are going to get pretty ugly for them, and there's not a whole heck of a lot they can do about it. So ever since 1989, when we're going all the way back to 89, Japan has been faced with kind of an overriding deflation. Their real estate, housing, stocks, everything got so overvalued that when the bubble burst, they had this massive deflationary force that's pushing on them. But they fought it. They did not want to go into a deflationary spiral, thinking, oh, we'll head into a depression. So their central bank basically just bought every bond out there that they could. They were trying to fight deflation. They were trying to create inflation. And they've been doing it for decades now. I was a senior in high school in 89 when this thing burst, and they've been doing this forever. And, and basically, if you look at this chart, the top part is the Nikkei. So that first spike on the far left is where it hit in 1989. And then you can see, I mean, it took them until just a couple of years, or until recently, just to get back to where that point was. So, I mean, it's been a lost, 20, 30 years here for Japan. And then when the yen carry went kaput last week, you can see a massive drop in the far left. So more than 20% down in just a couple days. So, so basically jumping back to, they have been trying to create inflation for all this time since 1989. And they've gotten to the point where the central bank, they bought government bonds, they bought private bonds, they even bought stocks, anything they could do to try to get some inflation. So they've built their balance sheet up to just a massive amount of money. And they weren't able to create any inflation. But now here, since 2022, when inflation started to really get a little nutty there, now all of a sudden they started having some inflation. But now when you have a massive amount of inflation and your balance sheet is stuffed with too much debt, now you've got a problem. They weren't thinking about this. They were only trying to trying to create inflation, avoid deflation. Well, now they've got inflation, but they have a massive amount of debt. Well, at that point, when you have a massive amount of debt, and this debt is at below 1%, like the central bank was trying so hard to create inflation that they were buying the debt at less than 1% for a long time. So now when you have inflation, and a massive amount of debt, sub 1%, well, you're not going to get anybody else to buy your bonds because nobody's going to do it when there's actually inflation. They want at least a return above inflation if you're going to be a bond investor. So now the central bank's in a kind of conundrum, because if they continue to support the bond market, and they have to do more and more and more because they've created this beast where they have so much debt. So they're refinancing a lot of this debt. And if they continue to do it at low rates, sub 1%, what happens is, because there's inflation, the yen is going to start to suffer. Their actual currency starts to lose value relative to everything else, which creates more inflation because they import so much of their raw goods. So you're getting more and more inflation. And if you keep bonds low like that, you've now all of a sudden created a point where the yen continues to lose value. So now you're in a situation that nobody wants to be in, because if you fight the inflation and you raise rates, you're going to kill the bond market. You're going to, your government at that point is going to be paying more and more and more in government debt and interest. So you've got a point now where the government, because they had the central bank buying their debt at sub 1%, well, now if they're paying 2, 3, 4%, it gets to be a point where they just can't do it anymore. The bond market could collapse because they just can't afford it. So they're in a bad spot. They can either save the bond market or they can save the currency. They can't do both. They're going to try to do both. They're jumping back and forth, support the yen, support the bond market. And basically what happened is the central bank in Japan raised rates unexpectedly to the market last week. And that's what caused this situation, because what's been happening here really since the 1990s is because Japan has been facing deflation. The yen it's always been very cheap to borrow yen and then invest elsewhere. So if you could borrow, if there's sub 1% interest rates on their government debt, you can borrow at that low rate and you get all this yen, and then you take it to the US and you convert it to dollars and you invest in treasuries, which had a much higher interest rate than that sub 1% you were borrowing at in Japan. So if US treasuries at 4% and the Japanese government debt's sub 1, you got a little carry there, right? You got 3% arbitrage. So if you borrow lots and lots of money, you get that 3%, you're paying back in sub 1%, but you're making 4%. It works out pretty well. But the problem is the X factor in all of this is the currency conversion. So if you knew that both currencies were going to remain steady relative to each other, that the US dollar and the yen were going to stay consistent, it's not a bad plan. You could sit and basically get 3 or 4% without putting any of your actual capital work. You're just borrowing. So you can make a lot of money doing it that way. But when the currencies start to get a little funky and fluctuating, well, you're setting yourself up, because currency moves, doesn't take much of a currency move to all of a sudden take that 3% spread you're making and evaporate it to the point where you're actually losing money. And that's exactly what happened with the yen carry trade. So it's a huge problem. As I mentioned, the Japanese central bank, their balance sheet is 120% the size of their gross domestic product. So they have an enormous debt load on their books. And for perspective here, the red line is our Federal Reserve, which is at 25% of our gross domestic product, which is still way too high. I mean, it's still nutty that we're at 25%, especially when you consider from 2007 all the way back to the start of the Fed in 1913, we never went above 5%. So just since 2008, they have fivefold their debt in the US, which seems obscene, and it is, but look at Japan, what they've done. So you can see this is a big issue. And to kind of give you an idea of how this really affects, this yen carry trade, this is going back to, the mid 90s to 98. And it was already in full effect then. And what people were doing is they were borrowing money in Japan and then investing in the US stock market because it was doing very well. So this is the Japanese yen divided by the US dollar. So you can see over that time, when the yen is losing value, this is a really good trade because you're taking yen and converting it to dollars. So this is a kind of an ideal situation if you're investing. Excuse me. You can see over this period when the yen was going down from 95 until a certain part in 98, till mid 98, yen's going down. U.S. stock market in black is going up, up, up. Well, then what kind of happened was we had remember the Asian crisis, the Russia crisis, and then long-term capital management. So if you've been an investor for that long, you probably remember all three of those things kind of happened all at once. We had real bad situation in currency markets, both in Asia, Russia, and then this hedge fund, long-term capital management, had over-leveraged their bets on currencies, and it blew up. So you can see the yen jumped considerably in a short period of time. And when that happened, you can also look at the black line, U.S. stock market tanked because people had all of a sudden to go back in and close out their yen carry trade. So all of a sudden, with the yen getting stronger, their investments turned against them. So they had to liquidate so that they could go back and essentially pay off their debt. So the problem is this isn't your own capital. This yen carry trade, you're not putting your own actual capital work, you're borrowing. And when you have leverage is a great thing when it works for you. Leverage is a horrible thing when it works against you. So this is what happened. Leverage went against investors, so they had to liquidate and cause the market to go down. But then after that, for the rest of the year, you can kind of see the orange line. The yen kind of steadied itself. It didn't come back down to where it was, but it steadied itself. And then that drop in the U.S. stock market, you can see off and running. Once the yen stopped, once it kind of stabilized itself, everything went back to normal. And maybe that's what happened here last week. The central bank of Japan did jump back in to try to support the yen. So maybe this year or this week was just a sign that, okay, this is stabilized. Now, the thing is, if you go back to the central bank here in 98, even the Japanese central bank, well, it doesn't even go back that far. You can kind of see that the Bank of Japan, and this is the year 2000, they were about 20% of their GDP. So in 98, there wasn't a massive amount of yen carry trade going on like there is today. So the yen carry trade is much, much bigger, based on the value of the debt that's on the Central Bank of Japan on their books. So a lot of people say, oh, okay, well, we got through that. It's just like 98, up, and away we go. And short term it might, but I think this is a problem that's going to be around for a while because, again, the amount of debt that Japan has now and their central bank has, it's really untenable. And because they now have inflation, they are in a spot where they have to save the yen or save the bond market, and they can't do both. And so we're going to see a lot of volatility with this yen carry trade because nobody knows exactly how big it is. But when you look at the size of the Japanese central bank, it's got to be pretty darn huge, just based on the size of how the debt on their books has gone up. So, as they're bouncing back and forth, trying to save the bond market and then jumping over and trying to save the yen, I think we're going to see a lot of volatility. We might see a lot more weeks like we saw last week, where people get caught with their pants down. And or what we might see is just kind of everybody across the board reducing their risk in the Japanese yen, which would also require them to sell, which would be bad for basically risk assets around the world. Okay, so I talked a lot about that. I hope I didn't confuse people more, but this is definitely something to watch, and it's something I've been talking about for a while. And I think what we saw last week might be just round one, or maybe it's not. Maybe that was it. Maybe all the players that got caught with their pants down have now reduced their risk, and they're in a good spot. But Japan's in a tough spot, and anybody that still has any kind of yen carry trade going on in their portfolio is going to probably have a rough time of it. So, like I said, that the big thing that caused the markets to go up this week, one, the yen kind of stabilized, but they also had good CPI numbers early in the week, and then a decent unemployment or continuing claims for unemployment benefits number was down about 30,000 below what they expected, and retail sales were better than expected. So retail sales were at 3% increase, most of that being automobiles, which I find that hard to believe because there's a lot of supply now, and we're starting to see prices come down. So if you're in the market for a car, just wait a little bit. You're probably going to get a good deal. But the thing is, what the markets do is they look at the headline number and they trade off of that, and they don't look under the cover or under the hood to see a little bit more. So yeah, it was a 3% increase in retail sales, but then they had downscaled the previous months considerably, so to the point where retail sales were actually dropping. So when you revise things down, say, oh yeah, we said they were up last month when we initially released the data, but actually they were down. But nobody looks at that stuff. So retail sales were actually down. And so, like I said at the beginning of this presentation, I've been trying to figure out this whole year, is it inflation, deflation? Where are we headed? I think we're in deflation. I really do. So retail sales, although this month was good, but I assume that'll probably be revised down next month. The thing is, I'm starting to see several factors that are pointing to deflation, things you only see in deflation or a recession. The bond market's the big one. I've always talked about it. The bond market's the smart money. The stock market's the dumb money. Bonds tell you the better story because the bond market is so much bigger. There's so much more money at risk. And this is just a chart showing you the 10-year yield on U.S. debt. So the yields are coming down considerably. So last at 3.88%, whereas just a few months ago, it was at 4.8%. And at the start of the year, it even touched the 5% position. And you can kind of see why I was struggling. Is it inflation, deflation? So beginning of the year, it got up to 5%. That's the bond market saying inflation is coming. Oh, but then it dropped considerably. Oh, okay, things are deflating. And then up and away we go again. So maybe we're in that same trend, but there's a lot of factors now telling me probably deflation. This is a big one. Just seeing how the bond market's been reacting the past couple months is telling me, all right, the bond market's expecting, it could be just lower inflation, but it also could be a slowing economy. And then the other thing is, we talked about this at the last presentation, the SOM rule. So SOM is a Federal Reserve economist, or past Federal Reserve economist, and she had come up with a calculation to show with unemployment, when you have a certain change of a 0.5% increase in the unemployment rate above what the average has been for the past year. So once you get to the point where you're, for a 3-month period, you go up 0.5%, and that's 0.5% above the average of the past year. Every single time that's happened, we've gone into recession. So that got triggered last week. And we'll see. The continuing claims, people are saying, well, maybe it's not the case because there were quite a few layoffs in July due to weather. So maybe that was just a temporary blip, but at least this thing has triggered officially, and it's never been wrong before. And then you look at the bond market plus this. So we're starting to build up some rules that, okay, it looks like we could be in a deflationary environment. And a lot of people say, well, unemployment's still so low. It's 4.3%. I say, yeah, it is. But if you look at the past recessions, it always starts off at a very low rate. It's never, way up there. What happens is we kind of go into recession. And then once people go, okay, yeah, we're in recession, employers do everything they can to not lay people off. And then all of a sudden they're like, well, we just got to do it. And then you see it kind of explode up. The moves up in unemployment are awfully fast, and they're awfully big. So you can kind of see every time we've sort of gone into it. Here we're looking at the year 2000 and then the 08. That's the red circles there. Unemployment was awfully low at those points as well. And then labor market, the conditions are starting to get a lot tighter. So this is Kansas City Fed that looks at this, and it's a lot of what job openings are there. How many people are quitting their jobs? So all these activities are going down. When a lot of people are quitting their jobs, they find that there's other jobs out there for them to move to. And then obviously the total number of job openings is clearly, pretty readily apparent if it's good or bad. And the other thing I've kind of been talking about here for a bit is just the amount of temporary help. That's the first thing that employers are going to cut. If you have somebody who's from a temp service, you're not going to cut one of your full or part-time employees. You're going to get rid of the temporary help because they're not actually employees of your firm. So that usually starts to drop at the start of a slowdown. And we've seen quite a drop in temporary help. So now we've got the bond market and the labor market kind of showing me things are slowing down for sure. And then we throw in some of the very cyclical sectors of the economy. The biggest one is housing. So we're starting to really see, the housing data that came out this week, again, kind of ignored by the markets, but we're seeing that permits are really dropping. So private housing permits is the blue line, and then new privately owned housing units started. So we've got the starts here, and we have permits. So permits are showing you what's coming down the pike, and the starts are actually up to the minute data, how many houses are being built at this time. And you're kind of seeing that, both are heading south. So housing, which is a very important part of our economy, when you figure out the employment part, but also the amount of commodities it uses, and then it factors into so many other areas of durable goods, furniture, appliances, everything like that. So as you have fewer and fewer housing starts, it seeps into the economy in just ways that you can't imagine. Realtors, mortgage loans, all that kind of stuff. So now we are starting to see housing really show some issues. And this is just showing in red is home buyer confidence. Is it a good time to buy a home or not? And you can see we're really at all-time lows on home buyer confidence. Even going back to the early 1980s and if this chart went back in the 70s, it'd probably be low too. Back when mortgage rates were, 15 to 20%. So people right now, even though mortgage rates have come down and they're sub 6 now, there's not a lot of confidence if you're a home buyer. And then home builder confidence is also starting to trend downwards. It's not collapsing yet, but it's definitely heading down. So even the home builders are getting a little bit nervous. And it also shows up in the price of lumber. So if you remember, if you tried to build anything during COVID, the price of lumber was just off the charts. But what we're seeing right now is that lumber is dropping awfully fast. The price is coming down. That is one of the bigger inputs for housing, of course. So in other parts of the economy, but really big in housing. So you can kind of see that the demand for lumber is dropping really fast. And it's not just in the housing part of it. So copper is one of the probably the most industrial metal out there. It's used in absolutely everything. Anything that's electrified is going to be filled with copper. And you can kind of see the price. It has been declining here this whole summer. A little spike here at the end, but for the most part, it's kind of showing a continued decline in demand for an industrial metal. That leads me to think that, all right, maybe we're slowing down here a little bit. Chapter 11 bankruptcy filings by corporations are steadily heading to the north. That is deflationary. Even in the individual sector for debt, we're starting to see a lot of loan defaults. So this is it's a busy chart. It shows you the different kinds of debt that we have. So if you look at the blue line, credit card debt delinquencies, 90 days or more, is definitely climbing. So are auto loans. Those are starting to climb as well. They're not too bad. Student loans have dropped off completely, and that's mostly because the government has put in, at COVID, they said there's a moratorium on basically coming after that debt. So that's going to be low no matter what. Now, the good news is mortgages and revolving lines of credit, which are usually tied to your mortgage or your home equity, those are still really low. And it kind of makes sense. You know, most people locked in that owned a house already, they locked and loaded back when they, when the rates dropped to, sub 3%. So they're hanging fine. There's no issues with that. But, auto loans and credit cards are very discretionary spending. So that sort of tells me there's trouble there as well. And this is showing the credit card delinquencies by age. And if you look at it, it's really every age group is seeing it climb. So it's not something like just the young kids are struggling and they're defaulting. Now, obviously, if you look at this, they're the biggest group of defaulters or highest percentage of those that are 90 days past, which makes sense. They don't have as big a salaries and, they're younger. They don't have cash reserves. So it's not too surprising. But what is surprising is, even the group that's 70 plus is seeing increases in credit card delinquencies. So this is across the board. So it's a little bit alarming, but what it tells me is, when you start to add all these up, it looks like deflation for sure. And this is auto loans by age too. So here it's pretty clear that's the younger folks probably bought too much of a car, and now that car payment's just too much. But again, every age group is seeing an increase in auto loan delinquencies. So, as I talk about it, the way I always try to figure out where are we in the economy, and I break it up in the quads. And quad one is kind of a sweet spot. You've got continuing growing economic activity, so GDP is going up, but inflation it's either disinflation or deflation. So inflation's not an issue, but economic growth is going up. That's the beauty spot. Quad two is you still have growth in the GDP, but you've got a little bit of inflation. So, okay, you've got inflation going up a little bit faster, but it doesn't matter because economic activity is going up. And that's kind of a natural thing. If the economy is growing, you should see the underlying components of the economy. That could be things like commodities that to build the products, could be labor, everything like that could be going up. But if the economy is growing, who cares? Quad three is where we see the GDP going down. So we have slowing economic activity, but we have higher inflation. So inflation continues to go up, but economic activity is going down. And then quad four is the deflation. So we have slowing economic growth, but we also have inflation that's either disinflation, so it's not going up, or actual deflation. And it looks like I'm thinking quad 4 is sort of where we're at. We're definitely slowing down, and I mean clearly on the CPI number, it is slowing. So definitely have either quad 1 or quad 4. So then it's like, okay, inflation's not as big of an issue. Is it because are we growing the economy, or is the economy starting to slow? So it looks like the economy is starting slow. There's a lot of things now showing that we're kind of heading to a deflationary part. So what do you want to be in when deflation hits? You definitely want to be in like consumer staples. You want to be in healthcare. You want to be in utilities, materials. Areas to avoid are going to be, tech, and then anything that's really tied to commodities, which would be energy and industrials. And you want to focus on, lower volatility stocks, higher dividend payers, and value stocks is what you want. This is an interesting chart, just showing you right now valuations for each of the sectors of the economy. And honestly, the only one that's kind of cheap right now is energy. So even though energy in quad 4 doesn't do well, it's still really, really cheap. And that's why I keep coming back to energy in a lot of different discussions. But I am selling some of the energy positions that we've got because they haven't declined like a lot of the commodities have, mostly because there's still a lot of uncertainty in the Middle East. But someone that we've got momentum is really definitely slowing on our energy, not quite like it is in other commodities. But I still think longer term, like, man, if you really want to just park your money somewhere, if you're not going to trade it a lot or look at it or worry about it, I think you're going to get rewarded if you're in energy. It's really cheap relative to its average. So, and utilities are fairly valued. I mean, but pretty cheap when you look at the other areas of the economy, the other sectors. So as I mentioned, this is the XLE, which is basically looking at energy producers. Kind of on a downcline. It's above the little green line there, which is 200-day, but it's definitely struggling a little bit here. Now, all that can change if war with Iran breaks out, in full. That would absolutely change. But if we're in kind of that quad 4, I think things are going to slow down for it. So I'm going to add some more utilities. I'm going to add some healthcare and some consumer staples. And the staples, I'm not going to just buy an ETF here. I'm trying to do something where we can find some holdings that are really lower on the price to earnings, but also higher on the dividend yield. So I'm trying to find what I would say is the best of the best in that area, rather than just buying the entire sector of consumer staples, kind of parsing it out a little bit and looking at some companies that offer some really compelling valuations. And these are some that I think are pretty good. AT&T, I mean, you're talking 11 price to earnings, so it's really low. Even if you go to historical return or historical price to earnings for a market at 15, it's cheap even on that. And right now, the PE in the market's more like 24. So this is really cheap relative to the market. And you're getting a 5% dividend yield. Philip Morris is another one. A lot of people don't like it. I know it's a cigarette company, but look at that, 8.74 price to earnings. I mean, come on. And a 7.8% dividend yield. So, I mean, that's cheap. Campbell Soup. It's at, a little just under 20, so it's a little bit higher than some of these other ones, but still that's pretty good, still relative to the market at 24, but it's got a 3% dividend yield. And all of these stocks have a pretty good momentum going with them. So they're all above their 200-day moving average. They're all heading north. Kroger, one of the biggest grocery store chains in the U.S., it's at 18 with a 2.4% dividend yield. And then General Mills, everybody knows is a cereal maker, but all kinds of products. They're just shy of 16 price to earnings with a 3.5% dividend yield. So if we're heading in a deflationary environment and staples do very well, I think these should probably do even better. But again, I'm not giving advice to anybody. This is, if you're a client, this is some of the things I'm doing. But if you're not a client, make sure you do your own research on this stuff. And when you look at the tech sector versus the consumer staple sector, you can kind of see we're at a ratio that we haven't seen since the tech bubble in 2000. So when you compare those two, the valuation of tech is just way, way higher than staples. And usually when we get this high, you probably expect some sort of correction. But like I mentioned, some other deflationary positions they're good. Utilities are always a good one. You're going to put the lights on. That's just how it works. Utilities also would benefit if the price of energy comes down. So they would possibly make a little bit more in profits. And of course, healthcare is another one that is used no matter what. You really don't have a choice in that one. So as always, again, I'm just talking here. I'm not giving you financial advice, especially when I'm talking about individual stocks. I'm not telling anybody who is not a client to go out and do that stuff unless you do your research or you talk to your advisor and they agree. But for clients where I'm managing your money, these are some of the moves that I'm looking to make. So I think that we're pretty, man, it looks like now I can say we're in that quad 4 slowing deflationary environment. I can't say with absolute certainty though. We'll see, but that's kind of what I'm looking at. And yeah, so I don't know if there's any questions. I don't see any. But the other big thing is, which affects a lot of folks, is that inherited IRA. So it's nice that the IRS 5 years later finally come out with their definitive ruling on this. And we'll see, that may not hold because of the Supreme Court case that essentially said that regulatory agencies, they don't necessarily have the last word and it can be challenged. So we'll see. But that's what we have to be focused on. I know I've got a lot of clients that have inherited IRAs. I've got a lot of clients that plan to give those IRAs to their kids. So this is going to be pretty important stuff. So outside that, I hope everybody has a great weekend. And again, please send me your questions because once I start getting a few questions from people, I know, okay, I need to address this. Yen carry trade was another one. I would talk about it, get nothing. And then it was in the news a lot last week. So all of a sudden I had 5 or 6 people ask me about that. So it's like, I probably need to talk about this. So anyway, hope you have a great weekend. Take care, everybody.